Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker, and with me today, I'm excited to have Conor Maguire. Conor is the founder of, I guess it's just Value Sits Substack. Conor, how's it going?
I'm good, Andrew. Yeah, good to be on the podcast. How are you?
Doing good. Hey, I was just laughing to myself. I think you might have the best accent of anyone who's come on the podcast so far. I'm just loving the accent. But let me start this podcast the way I do every podcast. First, a disclaimer to remind everyone: nothing on this podcast is investing advice. Always true, but I'll just give a little extra note that we're going to talk about an international stock. It is on the smaller cap side. So everybody, please, this is probably a little higher risk than normal. Please do your own work, consult a financial advisor, not financial advice. And then a second with the pitch for you, my guest. You and I were catching up beforehand. I remember when you started your Substack about a year ago, and you quoted me right back. I said, look, your first post was on it was Total Produce was merging with DOLE, if I remember correctly.
That's it. Yeah, that's right.
I'll generally link to people's first posts if they want, but I try to wait and feel it out. But I was like, as soon as I read it, I said, this Substack is going to be fantastic. And it's absolutely proven it. People are going to see today just all sorts of quirky situations all across the globe. So, you've actually got a big following. I had 5 people reach out when I said I was having you on, and they were like, I love the Substack. So just so excited to have you on, and so excited you've kind of got some traction going a year into Substacking.
No, that's great. Yeah, no, listen, you were one of the very early people to kind of give me a bit of a promotion online, and in your own newsletter. So I'm glad I'm still here and still sharing ideas. So it's great to be on the podcast. So looking forward to the discussion.
Hey, thanks so much. Well, let's just dive right in. The company we're going to talk about, it's WIX. The ticker is WIX, but if you look up WIX domestically in the US, you'll find WIX, the website company. This is WIX, it trades in London. It is a London home goods store, but I've probably talked too much already, so I'll turn it over to you. What is WIX and why are we so interested in it?
Yeah, no, thanks, Andrew. So WIX is the second largest home improvement and DIY retailer in the UK. So it was spun out of a larger building materials business, listed building materials business called Travis Perkins PLC about last April. And the rationale for the spin-off at the time really was Travis Perkins are more focused on the trade or the business to business material space. And so the decision was made to kind of simplify their business and spin off what is really essentially a kind of a retail focused business with WIX. So I suppose some comparables in the US may be something like Home Depot or Lowe's, but this is a much smaller business and obviously relative to the UK market as well, which is itself a much smaller market. So the spin-off was structured as a one-for-one share distribution to Travis Perkins shareholders. And as is often the case with a lot of spin situations like this, a lot of the big holders of Travis Perkins shares immediately sold off their stock or started selling the shares they received into the market over the last 9-10 months. And really the rationale for that really is that it's just mandate reasons. I mean, WIX is a kind of a 460 million pound sterling market cap business. Travis Perkins is, about 2.8 billion sterling market cap. So a much larger business. And I suppose one of the main reasons why the sell-off was 2 reasons really, I suppose, not wanting to own similar risk twice. In terms of investors, if they already own Travis Perkins, that was the much larger business. There was no reason to hold on to a smaller spin-off once they'd been distributed with the shares. And secondly, retail as well. There's probably a perception around retail, which I think in the case of WIX is misplaced, but we can get into that. But similar again to the US retail apocalypse, as the narrative is over there, the death of the high street, as they call it in the UK. Or death of UK retail. So it's probably suffered a little bit from that type of perception as well.
Great. That's all great. And I want to dive into all of that. Let me ask you a quick, simple question. You mentioned it reminds US listeners, Home Depot, Lowe's. My first simple question, is there any relation to Lowe's? Because when I was reading the deck, I was looking through the slide, like the color palette, all of it, it rhymes with Lowe's so much. Either there had to be a relationship or one of them stole each other's logos and color fonts and everything.
I don't know if there was anything stolen or anything. I would say it's purely coincidental, but no, there's no relationship. This is a totally 100% UK focused business. As I said, it's a small cap. It's about 1.5 billion in revenues, 460 million or so market cap. So they've no business outside of the UK, and it's an independent DIY retailer now, listed on the London Stock Exchange.
Great. And then just, look, one of the things that I find difficult about investing internationally is if you're talking US and, you talk to me about a retailer company, I can generally picture where they fall into it. Is it a super high-end retailer or is it lower end? IKEA is probably a step below, certainly a step below Restoration Hardware or something, right? With Wickes, it was just tough for me. Like in my mind initially, I thought, oh, this is the Lowe's of the UK, but it's not quite that big. It doesn't have the same selection. So where should people kind of think about the value proposition? Who's shopping there? Why are they shopping there?
Yeah, so no, Wickes's business model is our operating model is probably different to its main competitors in the market. So it's kind of straddles three segments of the home improvement or DIY market. So firstly, you've got the local trade business, which is where they supply materials to local tradesmen who are doing DIY projects for consumers. So these aren't large firms; these are usually one or two man band type, tradesmen who will get the materials they need efficiently from Wickes and then do whatever jobs for consumers separately to that. Secondly, there's what's called the DIFM or Do It For Me segment, which is really kind of the end-to-end service offering where the retail customer will go into Wickes store or onto their website, they'll speak to a consultant, and it's really kind of an end-to-end kind of, from concept to final installation of something like a kitchen, bathroom, flooring, tiling, that kind of thing. And then thirdly, it's the traditional DIY segment, which is, you go in, you buy whatever, paints, brushes, timber, whatever you need for your own personal DIY projects. So it's kind of very evenly balanced across those three segments, which is a little different to the competitors in the market. Then the second difference in terms of the mix really then is the operating model itself. So this is kind of a value for money, value retail type offering where they don't operate a big box model where, they try and stock every conceivable DIY item to meet all consumer needs. So they have a very focused, what they call a curated product range, where they stock in store about 9,000 SKUs, which compares to about 40,000 for their larger competitor, the market leader, which is B&Q, which is owned by Kingfisher, which is another listed PLC business in the UK. So they're much smaller product range, kind of lower price point, more value oriented, and then a smaller store footprint as well. So their average store size is about 20,000 square feet, 22,000 square feet, which compares to about 80,000 square feet, more like the big box type retail model that B&Q operates. So that's kind of where it sits. It's kind of more price conscious and kind of maybe more narrower product range, but what they do is they try and stock all the high demand, very reliable in demand products for home improvement.
Perfect. And, I was trying to find the slide as you were talking, but I couldn't quite find the slide. One of the things they argue in their decks is they're like, look, a lot of our competitors, as you were alluding to, kind of focus on one segment, right? They focus on the consumer or they focus on serving the pro. And Wickes argues, hey, we focus on everyone, and that is an advantage, which I can understand that. But at the same time, like, as you said, the stores are about a quarter of the size of peers. Like it does seem strange to go and say, hey, we focus on everyone with a store size a quarter of our peers, and because of that, it's an advantage. Does that make sense?
Well, I think it does, because they're trying to target that end of the market that isn't properly serviced by, or isn't sufficiently serviced by the larger peers. And you have to remember as well, the UK DIY market has gone through quite a bit of change. I mean, there's been a number of kind of bankruptcies or retailers that collapsed, and really there's only three kind of players, pure play kind of DIY home improvement retailers still standing. B&Q, which is the largest, then Wickes, which is the set number two, and then Homebase, which went through its own restructuring and kind of a distress scenario, which is the third largest. So outside of that, you're dealing with general retailers, value discount retailers, Amazon, kind of homeware businesses that might stock some kind of gardening or other kind of furniture type DIY related products. But I think the balance they have, it makes sense, and I think that shows through in kind of the track record. I mean, they've consistently grown revenues and earnings over the last 15 years, and that's through the great financial crisis in 08-09. That's through Brexit. It's through kind of the market in 2018 when Homebase went on this aggressive strategy when it was bought by an Australian conglomerate, which failed, and Wickes actually took advantage of that and grew market share. And then most recently, obviously, COVID. So they've been through, and then the pandemic. So they've been through kind of fair bit of turbulence, and really it's there's only a handful of players left, and WIX is kind of has its own very differentiated model, which I think, first it makes it interesting, and then secondly, obviously the valuation and another number of other attributes as well, which would make it really, I think, a really compelling situation.
We're going to talk valuation and the special sit setup in one second, but I just want to wrap up on the competitive landscape. You mentioned Amazon in there, and domestically, Amazon is obviously the big scary boogeyman to a lot of retailers. But at the same time, when you think Home Depot, you think Lowe's, those have done a great job of being insulated, and a lot of it has to do with they sell lots of heavy lots of heavy stuff, lots of things that Amazon can't easily pack in a warehouse and ship to your house. So I just the Amazon boogeyman, in the UK, like how much power does Amazon kind of have? And in the do-it-yourself segment, like a lot of what WIX is selling is the Home Depot type stuff that, isn't easy to ship, but they also sell a lot of stuff that, you probably could online ship through Amazon. So how scary is the Amazon threat there?
Yeah, I mean, it is certainly. I mean, it is one of their competitors, but I think maybe pick one of the key criteria, which is on price. And I did a quick spot check of kind of a couple of different product types on price, and WIX were actually slightly cheaper than Amazon's UK platform on a number of things like paints, paintbrushes, that kind of standard DIY items that consumers would look for. So, it competes pretty well against Amazon in that respect. And then with DIY as well, a big element of DIY is getting a bit of in-store advice or someone's advice on what you're trying to do, maybe which products to pick or and that kind of thing. Whereas obviously you don't get any of that with Amazon.
Perfect. Let's talk valuation, and then I want to go into the spin-off and kind of the remaining special situation here. So as you and I are talking, WIX last traded for about 181. Is that pence? I always forget. I think it's 181 pence. So let's talk valuation real quick here.
Yeah, so I mean, I look at this on a kind of what's called sometimes a post IFRS 16 basis. So just to kind of touch on that for a minute. So that includes lease obligations or lease as kind of notional debt on the balance sheet after the IFRS 16 standard came in, which is not something I think is reported in the US or in US GAAP, but
it actually is reported in the US, very similar to IFRS. 2 or 3 years ago, they made retailers bring all of their operating leases onto the balance sheet. And I'll let you continue, but it's certainly a big issue when looking at these guys. You'll pull up a retailer on Bloomberg and it'll say the thing's 50 times levered, and you'll be like, oh my God. And then you say, oh no, it's all their net cash. It's all operating leases, which, are a financial liability. But I'm sorry, please continue.
Yeah. So no, I mean, personally, I think, rent is just a business expense, like, utilities and so on. But I think it's important to look at it from both ways because, for example, WIX and a lot of its peers, they report, they operate fully leasehold models. So they lease all their stores. So you have to look at the total leverage picture. So I think it is relevant. So on a kind of including the leases and debt, it trades at about 5 times. Today, it trades at about 5 times EBITDA. And when you look at kind of private market transactions in the space, they've historically been around 6-7 times.
And is that 6-7 times you just mentioned? Is that on the like for like operating lease basis?
That's a mix. That's a mix from what I've been doing, because a lot of these deals, they don't disclose the kind of the in-depth financials. They involve private companies or subsidiaries, so it's not. I believe from the digging that I've done, I believe it's a mix. But
and let me ask you a nerdy question just to dive into that, and we can talk least more in a second. They give an adjusted EBITDA number, right? For the last LTM 2021, their adjusted EBITDA number was 219 million pounds. Is that
correct.
Adjusted EBITDA number they give? Does that add back rent, or is that with
That's
rent
before
already
rent? Correct. Yeah, that adds back rent. So the 219 million is before rent.
So it is a like for like number, because again, one of the issues is if you just take a normal adjusted EBITDA, so this would be more an EBITDAR number.
Correct.
EBITDA
correct, yeah.
with rent added back, which is perfect. If you're looking at something on an operating lease basis, that is how you should be looking at it. So great. Okay, perfect.
Yeah, so it's about 5 times on that basis, and then if you look at it on a kind of a in the traditional sense, where you net out the rent, you don't include the leases in the EV calculation, it's about 3.5 times.
Yep.
So either way, it's very cheap, and compared to private market comps, as I said, that's 6 to 7 times. If you look back at peers, the peer group over the last 10 years, which kind of to give a kind of a through the cycle type of perspective, that's been at about 10-11 times. So much higher. Now, retail landscape has obviously changed since then. So in more recent years, that multiple has trended downwards. But in terms of kind of against the comp set, the historic comp set, it's well below the historic average.
Now, you've said a couple times the retail landscape has obviously changed. And look, I don't disagree with that, right? Like Macy's, Kohl's, all these guys are really struggling. But at the same time, someone like Wickes, my mental model is I quickly think do it yourself, that there's some Amazon risk there, but not a ton. The trends are probably in their favor. We can talk about the aging UK housing stock, which is probably similar to the aging US housing stock and all this. And, I just go to my mental model, Home Depot over the past 5 years, the shares are about a double, right? And they pay out a nice little dividend. Lowe's, I think the shares have done really well, all this sort of stuff. So I guess my question is like, you've said death of retail, challenge retail industry, but for Wickes, is it?
No, I mean, that's my part of my thesis is that no, I mean, that death of the retail narrative doesn't apply to Wickes. I mean, and there's a couple of basic reasons for that. I mean, again, DIY, and if you look at the data historically, DIY has proven to be a very resilient industry through recessionary times. Just to give you a few data points. So great financial crisis, 08, 09, UK property prices declined nearly 20%. And over that 2-year period from 07 to 09, Wickes grew their revenues compounded about 5% per annum. So they grew through a recessionary period. And obviously DIY and home improvement is highly correlated to GDP and to house prices. Similarly, GDP at that time declined by 4.5%. So again, Wickes growing revenues at 5% compounded. It goes against that trend, showing its resilience. Then Brexit vote in 2016, there was a big knock to consumer confidence, but again, Wickes kept growing through that period, gaining market share, growing earnings. Then obviously, most recently, COVID, UK GDP declined, I think, 9.4%. And obviously because of the DIY boom that I think all DIY or home improvement retailers kind of experienced, Wickes has obviously grown very strongly through that. So it's proven to be a very resilient business. It's actually in the last 15 years, since it was originally acquired, I think, by Travis Perkins, it never has had a down year in terms of revenues year on year. The worst was flat, I think, in 2018. And that was because of Homebase, which was at the time a larger peer, was, as I mentioned earlier, was acquired by an Australian conglomerate called Wesfarmers. Wesfarmers bought Homebase, came into the UK market thinking they were going to disrupt it, completely botched the acquisition, ended up selling Homebase for £1 to a restructuring PE fund. So completely disastrous acquisition. Wickes managed through that kind of pretty short but intense kind of period of competition, grew their market share, grew revenues, and are now the number 2 player, about twice as large as Homebase is today.
Perfect. Let me ask you on opportunity costs, right? Because I think one of the things we've probably hopefully established at this point is Wickes is pretty cheap, right? IFRS adjusted basis, I think it's about 5 times EBITDA is what they're trading at. If you like price to earnings, price earnings probably 6.5, definitely under 7 times earnings. So this is a pretty cheap company. But one of the things I've hammered it home on the blog, I don't know if you've seen it or not, but there are a lot of cheap retailers out there, right? So just a couple I'm just looking at my screens. Like there's this little company that actually was featured on the pod, Cato, which owns some real estate. That's trading for under 3 times EBITDA. All of the sporting good retailers, which I've mentioned a ton in a bunch of places, Academy, Dick's, Sportsman Warehouse, all of them trade for, around 3 times trailing EBITDA. So I just have a question, opportunity cost. Like, why is Wickes the kind of cheap retailers play? Now, just to be clear, the EBITDA numbers I mentioned before are on it hasn't done leases. They probably trade for a similar multiple as Wickes if you do all the lease adjustments, everything. But, why is Wickes the best of the cheap retailers to buy?
Well, I think firstly, given where we are at the moment in terms of macro headwinds, recession fears, cost of living crisis, and so on, DIY within the retail space, DIY has proven to be very resilient, as I mentioned earlier. Number 2, on a multiple valuation, 5 times EBITDA, or call it pre IFRS 16, 3.5 times EBITDA. That's almost like a distressed valuation at that kind of a low multiple. It's below where private market comps have completed at. So, today it's kind of priced for the downside, but and you look at the price chart, the share price has just come down about 30-odd%, 35%, I think, pretty steadily because of all this forced selling. So, yeah, and that's in tandem with successively positive trading updates while the share price was trending downwards because of all this mandated selling. So, when the combination of those factors, non-fundamental selling, resilient business model, positive trading updates, and what I would argue, given where the UK housing market is at and the home improvement market is at, I think the prospects for it are pretty reasonable. Certainly much healthier than higher end or more discretionary, retail. So, that combination of factors, I think, makes WIX very attractive.
Perfect. So I think one of the theses here is this is a classic spin-off situation, right? This was spun about a year ago. It's the smaller piece of the spin. As you said, over the past year, the shares are down about 30%. And a lot of that is probably forced selling for people getting the smaller retailer and saying, I don't really need it. It's too small, not in my mandate, all that. Is that about right?
That's right. Yeah. So, I mean, when it was spun off, between when it's been spun off and now, about 21% of the share capital has been sold down by the original recipients of the shares in the share distribution. So that's that's been a big weight on the share price in terms of driving that forced selling. And when you look at the kind of the volume trends and the price action more recently, that certainly seems to be stabilizing now in terms of the volumes have stabilized. There isn't that same level of selling pressure, and the shareholder register, it's value managers now that hold maybe the top 3 or 4 positions in terms of maybe the 20% of share capital now.
I don't necessarily disagree, but I just want to push back on that thought a little bit, because that's the thing that it's the type of thing that got me really excited, but I also worry like, oh, am I just falling prey to a nice story? And I want to get into an eventy situation here. So I guess my 2 pushbacks would be, number one, I think the typical spin dynamics are like somebody spins off something completely different, like, AT&T spinning off Discovery. That's going to happen in the next 2 weeks or so. That kind of is typical because the typical AT&T shareholder is there for the dividend and they're there for like, the old sleepy telecom company. And now they're getting this growthy, kind of levered media company that wasn't even a part of AT&T 5 years ago. And they probably look at that and say, doesn't pay a dividend, completely different business. And they just sell and ask questions later, So that would be part A of the pushback. And then part B, most of the selling has happened over the past, let's say 6 months. And, the typical spin situation is most of the selling happens in the first 30 to 45 days of the spin, right? And I would say over the past 6 months, one of the things that happened is like, the macro outlook's gotten worse, and stocks like Home Depot has gone from over 400 to 300 right now. So I know you're saying spin dynamics, and I don't necessarily disagree, but at the same time, I look at it and say, maybe we're saying spin dynamics where it's just actually like the outlook's gotten worse and like it wasn't as badly sold as the typical spin. Does that make sense?
No, it makes sense. But what I would say in terms of the actual kind of selling pressure in the first 6 months post the spin, that's when the heaviest selling and most of the dumping of shares took place. And since then, it has kind of eased off. And in most recently, in the last quarter, it is when it really has stabilized. So I think, I think in terms of that kind of selling dynamic, it certainly, it's taken that amount of time to kind of wash through. Yeah, okay, the macro does look worse, but again, I go back to, when you look at the UK housing market, 80% of the UK housing stock is 30 years plus older. So, there is a kind of a structural, ongoing kind of, if not, total renovation, at least repair and maintenance requirement across the UK housing stock. That's not really, there's no getting around that. And then in addition to that, where WIX sits in terms of the retail segment, the kind of value for money, curated product range offering, I think, any kind of, required or necessary DIY expenditure, they should see, a fairly meaningful chunk of that, in terms of given where their market share is at. So, and again, they've invested a lot in digital channels, which has kind of really helped drive incremental growth as well.
Perfect. Now, the other thing with spin dynamics is a lot of times some of the opportunity presents itself because of the forced selling, which we've kind of talked about. But the other way the opportunity often presents itself is you've got this smaller subsidiary that's trapped in a larger piece, and they're kind of used as the cash cow, right? Where the larger subsidiary says, oh, that little piece, it's 10% of our value. We just take the cash flow, we bring it upstream, and we invest it in our bigger businesses. And I want to talk about that aspect for WIX because I was really interested. I'm looking at a quote from their Q4 call. They said, hey, it's been several years since we announced a comprehensive new store reopening program. And we're excited to announce we're planning to open 22 new stores over the next couple of years, which their store base is about, if I'm remembering correctly, about 250 stores. So this is a big increase, right? And when I saw that, I was like, oh, this is typical spin stuff. So I do want to talk about like the new store opening program. Why is now the time? Because one way to look at it is, oh, this was a company that had a lot of white space and they couldn't attack it underneath a bigger model. But the other way to look at it would be, oh, this is the Peloton issue, right? Your sales have ballooned over the last 2 years because of COVID. Everyone was stuck at home. Everyone was doing store remodeling. And you're using those last 2 years of really good trends to go justify opening a bunch of new stores. And then 2 years from now, you say, oh, actually the environment wasn't as good as we thought. And we opened a bunch of stores that are kind of unprofitable.
Yeah, no, I think this is different to obviously something like Peloton because firstly, WIX has been consistently profitable, and it's not growing exponentially because of COVID. It's growing steadily at 5%.
Peloton probably wasn't the right. I more use it as hey, the environment is so good right now, and you go on a big growth spree, and then a year later you say, oh, the environment wasn't. It was really boosted by COVID. It wasn't that the environment got permanently better and you accidentally overexpanded. Peloton was just a casual slip.
No, I understood, but I think, so on that point, so the plan is 20 new stores over the next 5 years. So, that's less than 10% of their existing store estate. And that's, it's not like they're rushing out to kind of sign up new leases and try and expand rapidly. That's a fairly measured, modest expansion. And it's probably opportunistic in nature in that the smaller footprint, it's a more efficient footprint to offer, more efficient footprint to operate. And also, given their scale and where they're at, they'll probably secure fairly reasonable lease terms in terms of price per square foot. So I think that doesn't really concern me in terms of an aggressive, over expansion at the wrong point in the cycle. I think that's going to be measured. I mean, they were clear on the call that was, I think, over a 5-year period. So, and their first priority is refitting the existing stores, which I think there's another 30 or so to go. And, to date, they've achieved, 25% higher sales performance relative to the older format stores post a refit on their refitted stores. So I think their approach makes sense.
The refit stores actually was the next thing I wanted to talk about. Obviously, this is mainly done. There are still stores to do, but they've mainly done it. I think it's 170 of the stores have been refitted.
Yes, it's about that. Yeah.
But, you just mentioned the stat, 25% sales performance from refitting stores, which that is mind blowing. Like I've seen quick service restaurants who they do a big update and their sales go up like 8% or something, but 25% for a do-it-yourself store getting remodeled, that is a huge sales bump. So what are they doing at these refitted stores that are driving such huge improvements in sales?
So part of that is it relates to their digital offerings. So, you can do click and collect or online orders. And what they'll do is they'll use their store estate as a distribution network for online orders. So if someone orders something online, they'll get it sent to the nearest store. So what they're doing a lot of the time is they're reconfiguring their store formats, freeing up maybe dead space as additional storage space to fulfill online, as well as servicing the footfall that comes into the store, and as well with kind of an increase in the do it for me revenue segment as well. You've got people coming into the store you get advice on what they want to do on a remodeling project or a renovation project, and that in turn, that additional footfall from offering that, which a lot of their competitors don't offer, they're driving additional revenues out of that as well.
Perfect. I want to talk capital allocation here. So I think when they initially spun, they were talking about paying out like it was either 18% sticking in my mind, but it might have been 30% of kind of free cash flow would go to shareholders as a dividend. And their new dividend policy is 40% of free cash flow to shareholders as a dividend, which is nice. As we mentioned, this is a company trading very cheaply. So if they're if they're going to pay out 40% of cash flow as a dividend, the yield is going to get pretty juicy pretty quickly. But at the same time, I look at that and I say, hey, this is a company that six or 6.5 times PE, you know, probably 3-ish times EBITDA, depending on how you're cutting the metrics. And I look at that and say, why isn't this a share buyback program? And longtime listeners will know I love me some share buybacks, but it was a curious choice. So I want to talk about that. And then I might transition into management after we talk about the capital allocation.
Yeah, so on the dividends, so yeah, it's running currently at about a 6% dividend yield. So you know, they did in terms of buybacks, they did mention in the latest results that that is on the radar. That's something they consider returning surplus cash to shareholders. Now cash has kind of come down since the half-year point because they've done an inventory rebuild. So and that's probably the intelligent thing to do in terms of kind of ensuring supply coming into the spring kind of trading season, which is kind of fairly important for the DIY space. So I think share buybacks will come if they continue to generate cash as they have to date, which I think they will. And so they want to finish the refit program. So that's probably the first use of cash, reinvesting it for that, which makes complete sense. The dividend, I suppose, to kind of return some capital to shareholders. And then after that, I think, yeah, the buybacks, if the stock price is still as depressed as it currently is, I think that's the next logical use of the cash.
Perfect. Let's talk management incentives here, because it's a UK company, so they give good data, but I didn't find maybe it's just because I'm used to the US companies, I didn't find their management comp quite as easy to do. But, you know, there were some tables that jumped out to me where one of the things with spin dynamics is a lot of times we talked about how you have this subsidiary that's kind of forgotten and they're used as a cash cow. But a lot of times what happens is they're spun off and a lot of entrepreneurial spirit is unlocked because the CEO, who used to get paid in the top company's stock, you know, so his division barely managed them. All of a sudden he gets a bunch of stock options struck in just his company. And he says, oh, it is time to go. It is time to create value. And, you know, they start growing as it seems WIX is going to start, but the shares come depressed from the selling. The management team gets a bunch of stock options and they just go create value, right? They grow the company, they buy back shares aggressively. And I guess what jumped out to me for WIX, I think there was a table that said the CEO, like his share ownership is equal to like 8% of his annual salary. If I remember that table correctly, I'm doing that off the top of my head. But, you know, I was struck by that and it kind of bled back to the capital allocation where I said, well, maybe if instead of 8% of his salary was in stock, maybe if it was 8 times his salary in stock, maybe he'd be looking to buy back shares right now. Or, you know, I was just worried about misalignment of incentives. So am I missing anything, or are you worried about that at all?
Yeah, no, you're right. I mean, in terms of spin dynamics, this is the skin in the game piece is the one element of this story that I would like to see more in. So yes, you're correct in kind of what you've outlined there. So management, you know, at the time of the spin, they don't own a lot of stock in the company. There is a kind of an incentive program where they have about, I think the CEO and the CFO now have about 1.2 million pounds worth of shares that options that don't vest for a number of years. But I think one thing that jumped out at me was, I think two or 3 days ago, the CEO started buying shares in the market
Interesting.
At sub 180 a share. So now it's a small amount. I think it's about 100 grand worth of shares, but you know, that's I suppose the first sign. You know, it's a relatively new management team in that they've been with WIX. I think the CEO has been with WIX since 2019. So kind of prior to the spin, kind of the second last year full ownership under Travis Perkins. So you know, and you know, he's managed the business through COVID and done quite well in that respect. So yeah, I would like to see management own more stock in the business, and I think we're seeing maybe the first signs of that now.
Perfect. We have covered a lot here. There are a couple other things I wanted to dive into, but I want to pause for a second here. Again, we've covered a lot, but is there anything you think we glossed over that we should have hit harder? Anything we haven't hit that you think we should have hit at this point?
No, I think we touched all the key points. I mean, really, I mean, the other thing I think that is interesting in terms of back to kind of, you know, you mentioned earlier, the macro has gotten worse, and, you know, also there's a lot of cash, you know, in the business. I think it's worth pointing out that, you know, the cash balance today is about 26% of the market cap. So I think that in terms of kind of thinking about downside, and I always think about downside as much as I do upside in these types of situations, you know, I think that cash position combined with the kind of the resilience of the business, I think, it makes me think there's a lot of downside protection in this setup as well.
No disagreement there. A couple other things. So you mentioned there are 3 different segments of Wix, right? There's the do-it-yourself, where somebody's going to go into a Wix store and they're going to buy paint, or they're going to buy tools, whatever, and they're going to go home and use it themselves. Then there's the do-it-for-me, which you go to the store, and Wix actually, they have, I think it's a Wix installer, right? They've got a handyman who's going to go, and you say, hey, I want to get my plumbing redone or something, and Wix is going to, plumbing might be too advanced, but I don't know. They're going to send out a guy. Wix is going to manage it end to end, right? And then there's the trade fi piece, where if you're a serviceman, I'll just stick with, you're a painter. You're going to go to Wix, you're going to buy paint from them, and then you're going to go do the job yourself. So you found the job on your own, you're just using Wix for supply. I want to talk about 2 of those different pieces. The first is the Wix installer piece. One of the things, I think 3 people pinged me on Twitter when I said we were looking at Wix, and they said, hey, I've looked at it, or I was a customer there. And one of the things that stopped me was the Wix installers had awful reviews, or my experience with the Wix installer was awful. And I'll let you talk about that in a second, but that there is something to that, right? Like, one of the stocks I've looked at a lot is Angie's List. And one of the constant bear pushbacks is, if you're a good plumber, you're a good electrician, you don't need Angie or you don't need Handy to give you business, right? Like, you've got more business than you can ever do. The only people who go on Angie are the really bad plumbers or the really bad electricians who can't get repeat business. So is there something to, like, Wix installers are actually the installers, the handymen, whatever it is, who actually can't make it on their own? So the Wix installer service is a lot worse than a normal installer, which, kind of has broad implications for the brand.
Yeah, no, I think, listen, I've seen a lot of those reviews. I've done a lot of digging on those reviews as well. I've looked at, on Reddit, on some of the threads are there as well. And, there is a mixed, I suppose, review pool of reviews there for Wix. But what I would say as well is that when you look at some of the peers as well, and look at maybe B&Q as well in terms of customer service and customer satisfaction, their feedback has been pretty mixed as well. So I don't think there's a huge amount between them. But what I would say is that this is a kind of one of the newer segments for Wix, and it takes time to build it up and kind of sort out your installer base, your installer network. COVID and the pandemic certainly wouldn't have helped that when there's shortages of labor and you're trying to source right people to fulfill orders, because Wix's order book is twice what it was coming into the start of last year. So it has a huge pipeline, of work there. And I think that also gives it an advantage in terms of recruiting, installers, in that, with increased uncertainty, in UK macro uncertainty, you've got installers are going to see there's a kind of a clear, reliable pipeline of work that's there, that will take them through this year at least and into next year. So I think that actually will support sales. The order book will support sales, and also I think it that it will attract kind of installers as well in terms of being ensuring that Wix can actually deliver on the pipeline.
Yeah, no, look, I do agree with you. And one of the other things about home reviews is it's really tough, because if you have a great plumber or a great electrician, it's one of those things that fades into the background a little bit, right? You're probably not going to go online and sing their praises. But if you have, if you're a plumber and you do 100 jobs and 99 of them are great, and one of them for whatever reason is awful, guess what? You're going to have 2 reviews online. One of them is going to be great and one of them is going to be awful. So it's just like such a negative sample bias there on the reviews. Though at the same time, I Googled Wix installer, and the results 4, 5, and 6 are 1.5 star ratings on 1,500 reviews. So it's both sides of the coin.
Yeah, no, I think at least I've done the same thing, and I've looked at a number of different review platforms, and it is a mix, and I think it does apply to their competitors as well. But I think, I think this is something that they'll improve on over time. It's a core part of their business now. It's a growth area for them, and so I think that's obviously an area of real focus for them.
Perfect. The other piece of their business, so we mentioned there's do it for me. That's the Wix installer. We just talked about that. Do it for yourself, which I don't think we need to talk about. But the other piece is the Trade Pro business, right? And the Trade Pro business is, I believe what it is if you're a handyman, whatever it is, you sign up for the WIX Trade Pro program, and WIX gives you 10% off everything in their store. And WIX has talked about, we've got this great base. I think they said, hey, we signed up. I'm trying to find the thing as we talk, as we talk. They signed up tons of people, and I'll give the numbers in a second. But yeah,
there's 630,000 members on the Trade Pro program, so that's grown from 550 this time last year. So that's growing nicely as well.
Yeah, so they added 80,000 people in 2021, so more than 10% growth in 2021. And then they said, hey, in the first 10 weeks of the year, we added another 26,000. So this thing's growing very quickly. And they've got all sorts of plans for what they're going to do with it. They want to increase the value and everything. And I just want to talk about the Trade Pro app, the Do It For Me. Like, how valuable is that really? Because how valuable is that really? Do you believe that there's any, like, as they get all these people, can they add incremental? Or is it, the grocery store around my corner, they do, hey, we give you 10% off if you're a member, but guess what? Their prices are just 10% higher than everywhere else. And they're just trying to get your phone number and stuff, right? So how much value does this really add? Does this make customers sticky? Can they create more value from this?
Yeah, no, I think it does add real value, because when you go online, you kind of price compare certain products. Again, WIX can be slightly cheaper. I mean, a lot of the retailers now will try and price match. But on the WIX app, it does, from the bits I've seen, it certainly does seem to be that kind of 10% cheaper. And I think, again, it kind of builds customer loyalty. WIX reliably stock a kind of a selected range of kind of essential kind of DIY items. So, the members know what they're getting. They're going to come back to it again. And when they need to get something, they know what they're getting. Again, that app is kind of being expanded in terms of targeted, offerings and so on, depending on the type of jobs that they've got. They're able to track the type of products people have bought, what kind of, they're able to discern then what type of products they do. Do they do bathrooms, or do they do kitchens, or tiling, or whatever? And so they can kind of build up, customized customer profiles and kind of, again, kind of just optimize what they offer those customers.
Yep. 2/3 of their sales, if I'm remembering correctly from the annual report, 2/3 of their sales are digital. That kind of surprised me for a do-it-yourself store, a hard goods store that people are going to go to. Is there anything going on with that number? Is that just COVID boosted, or is this really an online business it's online, it's just got the physical storefront to drive the online side?
Well, that 2/3, what they mean when they say that is that, about 2/3 of total sales are involve some kind of part of their digital ecosystem that they use. So it's not 66% of sales being ordered off their website. It's maybe click and collect would be included in that, for example.
Well, click and collect's huge, right? Because that omni-channel thing, one thesis I've had, and one thing that's been dancing around the back of my mind, which I didn't say, but like, this is 250 stores. They have an online presence. If there is a mom and pop store that is in one of their markets, right? The mom and pop store does not have the scale to do the online, the omni-channel, the buy now, pick up in store. They don't have the scale. So one thing I have thought about recently, and this applies to all retailers, is, sporting goods stores. Academy and Dick's, there's a lot of stuff going on with Nike cut off a lot of smaller sporting goods stores. But, if you're the mom and pop sporting goods store competing with an Academy and Dick's, you don't have that buy online, pick up in store capability. And I think it's probably the same with WIX, where their scale gives them capabilities that no one has, and that should let them be a consistent scale gainer over time.
Yeah, exactly. Yeah, I mean, they have a wide range of suppliers, so they've about 370 different suppliers. So they can, their buying power, their sourcing power for the product range that they have, local stores can't really match that. And then, when you're looking at, say, the competitor like B&Q, which is, the much larger competitor, it's a different offering. So it's kind of focused on its own kind of target segment of the market, which I think kind of differentiates it. So it kind of, hits that real need in between kind of the very small local independent operator and then the mass, the big box retailer.
Perfect. There is a line in there in your report, and I also think they were asked about this on the last call. They still have 30 million in spin-off, I think it's like dis-synergy costs that are
demerger costs. Yeah.
And 30 million, that is a big number, right? This is a less than 500 million market cap company. Adjusted EBITDA for 2021, as I mentioned earlier, was 220. So that 30 million is a big cost. So I guess I had two questions. A, what do they have left to kind of pay this 30 million cost? Like what is left to be done? Because anybody here is spin-off costs, and there are worries, right? I've seen cases of really bad ERP like spin-off things. So there are worries about cost escalating, the company just getting run out of control because they can't handle it. So that's number one. And then number two, which is probably a little simpler, the 30 million, are these one-time costs that they need to pay? So I could kind of just deduct that 30 million from their cash balance if I wanted, or is this 30 million of like kind of ongoing annual costs? So their 220 million EBITDA is actually going to be 190 million if they're run rating the same thing in a year.
No, it's once off in nature. So it's about 30 million of demerger costs that they'll have to pay down or kind of clear over this year and into next year. So it's kind of over 18 months.
So I could probably just pull it from the cash number if I really wanted to.
Yeah, exactly. That's how I think about it. Yeah.
And what are the remaining costs? I mean, is this hiring, one of the great things about a merger, you have a CFO, I have a CFO. Guess what? Your CFO is probably gone. And if I'm buying you, is this hiring, like, obviously they've got a CFO and CEO, but is this hiring a full accounting team? Is it investing in ERP, or are there other costs I'm kind of not thinking about?
No, I think the types of costs involved, I think as part of the spin, they would have had a kind of a transition agreement with Travis Perkins in terms of kind of de-integrating themselves out of, Travis Perkins systems and so on. So I think a chunk of it is related to IT costs and other things, just in terms of, totally extracting themselves out of Travis Perkins and kind of, standing on their own 2 feet.
Perfect. Anything else we should be talking about with WIX? I think we've gone through everything I want to talk about.
No, the thesis in my view is pretty simple. I mean, it's very cheap. It's a pretty resilient business. It's got good growth prospects relative to other retailers. And I think the share price just reflects really non-fundamental selling. And again, you look at private market assets, which I think give an indication as to what maybe the real value of this business would be, and it kind of suggests it should be much higher than the current share price.
No, look, I will tell you, I read this when you wrote it up, but as I was prepping for this podcast, again, one of my big themes recently has been, I think a lot of retailers across the board are too cheap, but I've got to get comfortable with the accounting and I've got to do a lot more work. But as I was reading, I was like, look, this is probably, if I talked about something like Foot Locker, right? Foot Locker is trading at 3 times EBITDA-ish, but guess what? That is a lot more discretionary. They've got a lot of issues with, we don't have to talk about it here. I've said it a few times in the pod. They've got a lot of issues with Nike's pulling back on their supply, and Nike's like 70% of their sales. So Nike pulling back on their supply is an issue. A lot more discretionary, probably a lot more exposed to online trends, a lot of mall retail, whereas WIX is like, hey, a lot of the stuff are in their favor, right? Like you can see the multiple Home Depot and Lowe's trade at. Yes, there are some risks here. Yes, maybe they got a little COVID bump, but the UK housing stock, similar to the US housing stock, it's aging. I don't think those trends are going anywhere. They've got a lot of online advantages. I think they're going to continue taking mom and pop. So super fascinating situation. We've almost hit an hour, but I'm looking at your Q1 situation review. I'm looking at your weekly bulletin. I'll include a link to both Conor's blog and his WIX write-up in the show notes, so everybody should check that out. But what else is top of your mind right now? What other situations are you kind of following? I'll put you on the spot.
Yeah, well, I think there's a few. I have kind of a pipeline of kind of maybe 4 or 5 ideas I'm working on at the moment, which I'll probably publish over the course of the next couple of months in the newsletter. I kind of, just that you mentioned the Q1 review. So I think, the names that I've kind of focused on so far have kind of done reasonably well, on balance. I think, DOLE, which is around the first one, which I had a lot of conviction around, that's really hasn't worked out just yet.
It's been a dog, yeah.
But I think, I'm constantly asked about that one, but I think, that the thesis, my thesis on that hasn't really changed. I think that's still, I think that's more a case of familiarity. There's still the perception that it's David Murdoch's company and so on, and it's really not. It's a very different business now. So I think that I find still very interesting. I think some of the.
Can I ask you a quick question on DOLE? Look, I haven't been super up to date on the situation since last summer, but inflation's top of everyone's mind, supply issues, inflation, all this sort of stuff. Is DOLE really benefiting from the supply chain tightness? You see a lot of companies' supply chains get tight and their profits go way up because they get pricing power, or are they really hurt because just all the issues, supply chain, paying a bunch for freight, having trouble getting products to market, all that type of stuff.
Yeah, I mean, that's obviously one of the big kind of concerns with DOLE from a number of people I've spoken to. But the thing about DOLE is it's the largest fresh produce business in the world by a factor. It's 2 times greater than the next, largest peer. It owns its own global supply chain infrastructure. So it owns its own ships, it owns farms, it owns all its distribution warehousing centers. So it has control over its supply chain, and so that obviously gives it an advantage. And I think then in addition to that, they've actually agreed price increases with all their customers across the business for 2022. So that should protect margins. That should offset any price increases that they suffer on the cost increases that they suffer on the input side. So I think they should be able to hedge that out, on the inflation side. And I think again, stepping back, they sell, fresh produce. This is about as staple as it gets. And they've over 700 fruit or vegetable categories. So that's not something that's going to suddenly not be in demand.
Anything else? I mean, I know you've got Yellow Cake Uranium, Willis Tower Watson, which probably jumps out because you've got all these quirky international situations, and then you've got Willis Tower Watson, this large cap US broker, which I know the story, merger break and all that. But anything else you jump out that our listeners, if they're looking to cheat off, you should kind of ramp up to speed quickly?
Yeah, I think one of the names I've covered is Kenmare Resources, which is a mineral sand miner. I think that's a really interesting situation. I think that a very unique asset. And I think that's worth I think people having a look at if they're interested. I actually did a podcast with T-Webs on that previously.
How dare you? How dare you, good sir?
So that's a good one. That's an interesting one. Yeah, Yellow Cake you mentioned. I think uranium. I think probably of all the commodity themes, I think that's possibly the most interesting in terms of the asymmetry there. I think is really compelling.
Yeah. I will be honest, I have not read the Kenmare piece yet. What resource does Kenmare mine?
So its main product is ilmenite, which is a mineral sand that's used in titanium oxide, which is used in pigments, titanium metal, all kinds of industrial applications. So again, similar to a lot of the other commodity setups, very tight, constrained supply. Strong demand, probably getting stronger now with increase in defense spending and titanium metal as a key commodity is that part of that theme. So that's an interesting one. And Kenmare is a very unique asset and very unique kind of play within that theme.
That's really interesting. And I see they've got share buybacks, which I love. No, Kenmare, just all across the board with commodity plays, it's where I've been spending a lot of time recently because I keep looking at these, and I've said this before, so if people read the blog, I'm probably just repeating myself, but I look at these things and there's companies with US domestic nat gas people, right? The long-term nat gas has gone from 2026 pricing has gone from 3 to probably 450 over the past 6 months, and you're seeing these stocks, and yeah, some of them have gone up 10, 20, 30%. Some of them have gone up more, but if your key input has gone up by 50%, like your overall value has gone up actually more than 50% because it basically falls to, but like, it just seems that the stocks have priced it like the long-term trend has gone from 3 to 325. And it's like, no, like these guys could go hedge 6 years out at 450 right now. And I'm seeing this diversion across the board. And it sounds like Kenmare is the same thing where it's like their price is going sky high and the stock just doesn't seem to believe it, and I'm not sure what I'm missing.
Yeah, well, in the case of Kenmare, it's a pretty obscure stock. In terms of mining, mineral sands is very obscure. Kenmare is an Irish company that owns a mine in Mozambique, and it's got a single 100-year mine.
Well, that explains a lot of price lagging there. That's an instant pass for 99% of people.
Yeah, exactly, and it's got about 2 or maybe 3 analysts covering it, so it's very underfollowed. But it's a kind of globally important commodity that it produces. So it's just under the radar.
Yeah, and it's under the radar. But I'm just stealing from your write-up. But $100 million in capital returned to shareholders in fiscal 2021. 215 million of EBITDA, 160 million of free cash flow. Like, yeah, it's under the radar, but this is a real company, right? They're being run professionally. They're returning capital to shareholders. Where was their mine?
It's in Mozambique.
Any other than the normal geopolitical risk, any other geopolitical risk with that mine?
So, I mean, there's two things I suppose to think about it. Firstly, there's, I suppose, in some African countries, there's question marks over governance and relationship with the government, and the kind of the risk there that something could be seized. So, on that front, Kenmare have been in Mozambique since I think 1987. So they have a very long history of working in the country. They've invested a lot in the local community. They've built schools. They've built, medical clinics and so on. So they do a lot. They invest a lot around the area around the mine. The government gets royalties off the mine. It also gets tax revenues from the mine. It's a big employer in the region it's in. So I think from that kind of just general political risk perspective, I think it's okay. I think it's I'd be reasonably comfortable with it. The second one then is there's a kind of an insurgency, a militant insurgency elsewhere in Mozambique. I think it's about 700 miles away from where Kenmare is located. So again, it's pretty far away. And I think that insurgency has been kind of quelled by peacekeeping forces and government forces on. So I think that's not as big a risk as maybe some people might have flagged.
Perfect. Well, Conor, this has been so great. Anyone who's not following your value set should. It's one of the best Substacks out there. My biggest fear, I'm going to invite you back on the podcast. I'd love to have you on next time you have a great idea. But my biggest fear is somebody's going to hire you away and the value set Substack is going to get closed, because that does seem to be a trend among many of my favorite Substack people, which I'm very happy for them. But selfishly, I'm a little sad to see them go, because I lose podcast guests and I lose a great source of idea flow. So that is a hint. If I don't know what you do actually, but that is a hint. If anybody's looking for a great global analyst, Conor, you should at least follow value sets. So anyway, any last words from you?
No, thanks for that, Andrew. Thanks for the kind words there. No, listen, I'm really enjoying writing the newsletter, getting good traction, getting to get in touch with a lot of interesting people like yourself. So no, it's definitely something I intend continuing to do. So it's just all about coming up with the next idea.
It's the best thing about writing. People ask all the time, why do you do the podcast? Why do you do the blog? It's like the best thing about it. I really enjoy it, but you meet so many cool people who you never would have met. This job, a lot of it is just sitting at my apartment, Penny's behind me, but it's just you by yourself looking at screens, and the people you meet from the podcast and the blog, it's the best part. And you're one of them. So Conor, thank you so much for coming on. Looking forward to having you in the future, and we'll chat soon.
That's great. Great to speak to you, Andrew. Thanks for the time.